Hello, and welcome to our latest video chat in the Money Show Expert Interview Series. I'm Mike Larson, Editor-in-Chief at Money Show, and today I have the pleasure of speaking with Mark Mahaney, Senior Managing Director and Head of Internet Research at Evercore ISI. Mark, thanks for taking some time out to chat today.
Great chatting with you, Mike.
Thank you. Let's start out with the big picture here for the tech sector. I looked at some of your work, and late last year, you had pointed out internet stocks essentially had the worst performance in many years in 2022. But you also said you were tactically constructive on the stocks you follow in 2023. And you mentioned an interesting thing called an EPS slingshot opportunity there. Is that view still current? And if so, could you expand a little bit on what that means?
Yeah, the view is still current. So, we tried to be muted and cautious in 22. We should have just been flat out bearish. Going into 23, we thought three things created a pretty interesting setup for growth equities, for tech equities. And that is one, multiples have been de-risked. In the space that we look at, the average forward multiple on cash flow went from a high of 25 times kind of in late 2020, early 21, down to a low of about 11 times. Multiples can always fall further, but that was below the historic average. And so we thought that the point was simple. Multiples have been de-risked. It just creates a little bit more of an asymmetric, risk reward outlook. Secondly, estimates have been de-risked. And so we went through 3 or 4 quarters in 2022 and at the end of 21, where there were very broad and deep negative earnings revisions after quarters. Usually the stocks follow the direction of estimates. If estimates are going up, stocks go up. Not always, but that general rule holds. And it also holds the other way. When estimates come down, stocks go down. So we had 3 or 4 quarters of really sharp, broad negative revisions. And we thought that it kind of wound its course and we're going to get back to the more normal stance of somewhere between 45 and 55% of estimate revisions in any quarter would be positive or negative. And we were going like 70, 75% negative. So anyway, we thought estimates had been de-risked. And then the third thing was the slingshot opportunity you talked about. And that's because companies were taking cost actions. That's a very polite way of saying reduction in force, which is another polite way of saying they were laying off people for 2 major reasons. First, I think there's a good number of companies. I think Google is in that camp. Meta was in that camp, Meta, Facebook, and Amazon, that frankly over-extrapolated from demand trends in the COVID crisis. And so they overhired. And then the second thing that kind of compounded the problem is that you started seeing softening demand trends as macro conditions, especially for consumer discretionary names, started to soften. And so you had this double whammy. It required these companies to start laying off employees. And I know that's no fun. I've been involved with that. It's a painful process all around, but it was a necessary process. Just like households tighten belts during economic downturns, so must corporations. So these companies did that. But what that meant in terms of the EPS slingshot, and Mike, to finally get around to answering your question, is when revenue eventually reaccelerates, when we get that macro recovery, and we haven't seen that yet, but when we eventually get that, you're going to be doing it off a lower cost base. So it creates this opportunity for earnings growth to really slingshot, out of the economic soft patch. That's what created what I thought was a more tactically constructive outlook for the group, and we think that the results we've seen year to date have largely confirmed that. So we're constructive, but we want to be tactical about it. And to wrap it up, we're looking for stocks that look to us to be somewhat recession resistant, clearly have had multiples taken down, which is a lot of stocks, but only a few are really somewhat recession resistant. Nothing's recession proof. And then maybe companies that have got really interesting new product cycles. And that list for us is Meta first, Uber second, and Netflix third. Those are our top 3 picks for the year.
Okay, perfect. Where do you think we are in that layoff cycle? I mean, again, it's something that even average investors who may not follow tech specifically are seeing those headlines all the time. I'm kind of wondering how long do you think that process will last? How long we'll be hearing about that this year?
It depends on how steep, whether we go, depends on what the landing is like. If we have no landing or soft landing, I don't know that we need to see major cuts. Some of the companies that I thought were the biggest laggards at cutting costs have gone and aggressively done that. With the one exception, I think Google still strikes me as a company that probably is overhired and still needs to right-size its workforce. But it's over 70% of the consumer technology stocks that I look at that have had layoffs of 5% or more. And there's some really interesting examples, Mike. There's this one wonderful, my favorite example from the entire earnings season that was reported about a month ago came from Airbnb, which disclosed that their revenue had grown 75% from 2019 to 2022. So that's going through the entire COVID cycle, yet its headcount was down 5%. Like, that is rare. You hear of a company that can grow revenue like that on a reduced user base. Now, probably said that they may have been overstaffed in the very beginning. Maybe it says that, I don't know, or they just learned dramatic cost efficiency. So I think we're largely through it, unless, Mike, we really get a hard landing and we get a really steep economic recession at the end of this year and early 24. And that probably won't happen, but that's a probable. And it also depends if we get another Ukraine-like shock, if we get another to the economic system, if we get another China supply chain shock like we had last year, all bets are off, and we could well be in a situation where more cuts would be required.
Got it. You mentioned China there, and that kind of kicks off to the next question I had, which is the regulatory environment. Where do we stand with some of the privacy issues? Obviously we have issues with the U.S. and China fighting over TikTok and data privacy there. I'm wondering if you could speak to that a little bit and kind of what impact you see on some of the stocks you follow with regulatory issues.
I made this point about a year ago that I thought we were at peak regulatory risk. I think that's true. Of the major tech platforms, I think for some time now, the two that have been most at risk of regulatory action have been Google and Apple. And then sort of third was Facebook. But Google and Apple, just because they have such potential power, they have a lot of actual power, just being something almost akin to gatekeepers in terms of their operating systems, iOS and Android. In terms of and particularly in terms of Google, just how dominant its market share is. It's a company that I think almost irregardless of what Bing really does, I think they're going to likely sustain their 90% plus market share. So they're just much more open to antitrust investigations and potential penalties. And they have paid penalties in the past. So those two stocks kind of remain there. I think the privacy and the social health impact of Facebook always sits out there because Facebook is us, because it's so broad, it's so widely used. If you got 2 billion people, all you need is 1% of them. And 1% of 2 billion is 20 million. That's a lot of bad actors, potential bad actors out there. And I'm not saying that there are that many bad actors, but I'm just trying to show you what happens with the numbers, just given how large it is. And so I think that's always going to be an issue for Facebook. But in terms of the competitive risk of Facebook, I mean, the rise of TikTok kind of gutted the argument that there was any sort of monopoly position that Facebook had. So I sort of feel like most of the privacy risk associated with Facebook, I think that's peaked, and I think it started to ebb. There are other issues there. They're much more related to competition and to technology and improving their ad targeting after the Apple privacy changes. I think those are much bigger factors on a name like Meta.
Got it. Okay. One other question I want to run by you. I mean, you can't turn on the news without saying something about Chat GPT, the AI phenomenon, and so on. And obviously, that's going to be a key driver in parts of tech. But I'm wondering if there's any new developments or technologies that you're seeing that maybe aren't getting as much attention, but that could probably be something investors should be following again in your space.
I know there are. I just think that the rollout and the use of generative AI is the single biggest thing we should be focusing on. And I'm not sure it's as akin as the PC revolution and the internet revolution. And I sort of feel probably not. But there were these other trends in there, and we all lived through the mobile phone revolution, which just dramatically democratized and expanded internet usage and created businesses that wouldn't be here. I can think of Uber, I can think of a Spotify that just wouldn't exist without mobile internet usage. And so that's what I wonder about with generative AI. My guess is that it's largely a real big process improvement, and it could have an impact on a wide variety of industries. So I'm not sure one can spend too much time trying to understand the ramifications of generative AI. So that's what I'm focused on.
Okay. I guess one final question would be if there's maybe a sneak peek you could give to what you think you might be talking about at the Money Show in Las Vegas. Any big topics that you think investors, or again, when you get your chance to take the stage, really need to focus on?
Well, Mike, it's you laid out the questions correctly, and these are the questions that we need to continue to address. Look, tech and growth stocks have nicely outperformed the market year to date. Is it sustainable? So that comes down to this question of, are multiples still de-risk? Are estimates still de-risk? And our estimates, do they capture what could happen in different macroeconomic environments? Those are still key issues. And then, when it comes to growth in tech stocks, it's always about the innovation. I mean, interest rates truly matter, but what's going to matter whether companies get bigger or not through an interest rate cycle is what's happened to their basic growth and in their growth strategies, and particularly innovation strategies. And so that's the one topic we didn't talk too much about today, except you touched on generative AI. So it's time for us. So that's what you're going to hear me focus on a little bit more. In the book I published 2 years ago or a year and a half ago, it's all about finding the most innovative companies. Those companies that's where valuations tend to take care of themselves if they're really successfully innovative. So we're going to spend a fair amount of time highlighting a couple of companies that I think are, a couple of companies that I think aren't.
Perfect. Yeah, I think it'll be nice to maybe take off our macro hats for a while and focus on some of the micro stories and technology in particular. Mark, thank you so much for your insights, and thank you all for watching. I do hope you enjoyed this interview. If you did, you're going to love seeing experts like Mark in person at our upcoming Money Show Traders Expo. We're all set for April 24th to 26th in Las Vegas. Click the link in the video description below. You can learn a little bit more about how to join us at our new venue for 2023, which is the Paris, Las Vegas. Thanks again, guys.
Thanks, Mike.